Good day. It's Wednesday, August the 11th. I'm Martin Gagel with Market Radius Research. Today we've got Gwen Preston, the resource maven, I guess. She writes a Resource Maven mining investment newsletter. I've got Gwen on really for one reason. She's a good mining analyst and has some solid ideas and can teach us about the mining and exploration markets. These are neither recommendations nor investment advice. We're here to learn about the market, Gwen, and some of her ideas in the investment industry and in the mining markets. So make sure you do your own due diligence and come to your own investment conclusions. Gwen, thanks for joining us today. Let's hear what you got to say.
Thanks so much for having me. Hello, everyone. Thanks for tuning in on a Wednesday morning in August. It's beautiful and sunny out, and I know August is a tough month to be at our desks. So thanks for the attention and interest. I'm going to run through sort of a where are we in the metals space macro look for a couple of slides here, because of course no investment thesis makes sense if it doesn't have macroeconomic support. So I was going to run through that to start with, and then I might linger more on my last few slides, which are sort of, if you think that there is an opportunity in the metal space, how might one position part of their portfolio to take advantage of that. And of course, there's a lot of factors that are personal in that, but that's sort of the lay of the land here. This title here, So Many Forces, So Little Understood, is really a reflection of how frustrating the gold space is right now, because there are a lot of forces buffeting the price here and there. And it's very difficult in the very short term to know what's happening. But I think there's a lot of reason to have confidence longer term in this commodities market. So short term, tough to know. Longer term, I'm pretty positive on this space. There we go. It is changing slides. Overall, commodities have been really strong. So this is like the S&P commodities index. It ran hard in the first sort of 4 months of the year, and then it's pretty much held its ground. It's traded sideways since then, amongst everything that's happened COVID and recovery wise. And that did just bring us back to the pre-COVID level, but the pace of the ascent was notable. And it's because there really was a surge of investor interest in this concept of reopening and commodities and how they perform in the kind of interest rate environment that we're in. And so then the question is, can a run like this last? Is there more, or is this it? Did people miss it? So I'm just going to quickly run through the fundamentals. So like what forces, supply demand type things might be pushing that. Technicals, just for a moment, sort of what do the charts say? And then what does the history say about runs like this and whether they continue?
Gwen, sorry, just flipping back to that one slide. That's a 12-month chart?
Yeah, that's a 12-month chart.
So if it was like a 2-year chart, it would be kind of a U shape, that kind of.
Yeah, it would have a pretty sharp decline, and then, the good old COVID crash decline. Yeah. And then it took a while to get going again, right? Because it took a while for anybody to have confidence in a recovery. But then once confidence kicked in, which happened right at the end of 2020, then it really did just run. And like a 23% gain in a commodities index, that's notable. I think that's something that you pay attention to.
Yeah.
And, there were quite a few specific commodities out there that really grabbed attention. Like everyone will remember, I don't think everybody has spoken so much about the price of lumber as they did earlier this year, right? And so that's one of the types of things that would contribute. Coal has really gone on a run. Iron ore really went on a run in that time. So this is a broad commodity. I like to talk about gold a lot, but this is broad. This is the commodities index, and it really...
and the biggest weighting in that commodity index is oil.
Yes.
Because that is globally the most valuable traded one. But other ones like copper, that is... it's fundamentally up then from where it was 2 years ago. It didn't face that same U. It's just up still. Yeah,
and good point. So here on this slide, I have 1 year price charts for copper and nickel. Might have been more useful if I had had two, but copper, yeah, if you go to the 5-year price chart, it's basically an upward trend with steps, of course. Nothing just goes straight up. But and that's because of the big picture here, right? Where we had a real bear market for commodities. And when I speak about commodities, I'm not talking much about oil because that's not I don't do energy in particular. I do the things that are mined. But there was that real bear market in metals, from 2012 through to 2016, people just left them alone completely. And then, that creates a solid fundamental backdrop, right? Because there's insufficient investment. Companies don't build new mines, but demand keeps rising. I mean, copper demand is mostly a function of population and electrification, and those things stayed in play, right? And so demand keeps rising, and at some point you got to pay the piper. And so that's really what's going on in the copper space, in the nickel space as well. So like I've said on this slide, sort of the reason that these rises have happened isn't much to do with COVID. Of course, COVID impacted the charts and set things askew for a while. And then there was recoveries from those weirdnesses. But really, this is about, demand rising and supply being insufficient because of that bear market that we had. And when projects weren't built and investors weren't investing, and so exploration didn't happen, and all of those things got slowed. And, I could spend a long time talking about this, but I won't. I mean, nickel demand, nickel's always been a stainless steel thing, right? But nickel demand is going to double in the next, 15 years because of battery demand. So that's a good capture of how much electrification is really impacting metals. It is creating immense new demand for a bunch of different metals. Copper and nickel are the behemoths out there, but there's certainly also there's other players out there. I mean, there's all kinds of conversations about platinum and palladium, and let alone lithium and cadmium and all kinds of other metals out there. So at the end of the day, strong demand against weak supply is a pretty broad brush, but a fair brush to paint metals with right now. And it is the real backdrop for these price gains. So here, like I say, iron ore has been very strong. It's fallen off a bit recently, but palladium has been very strong, right? So this is just strong demand against weak supply. So that's the backdrop, and that isn't changing soon. We certainly, for almost all of these major metals, we're still in a structural deficit outlook. Maybe not for some metals more dramatic, for some metals not particularly dramatic, but there's very few metals out there that are oversupplied in the medium term. And so that's bullish.
What is the lesser out of supply unbalanced markets where there's a relatively a lot of supply compared to the demand?
So zinc is a pretty well-balanced market right now. That doesn't mean that a good zinc discovery doesn't work, right? Discoveries can happen regardless of fundamentals if they're good, but zinc is fairly well supplied right now. And then if you're focusing on the battery space, you often get questions about some of the more unusual components. So lithium is one that comes up a lot. And I mean, I've spent days researching lithium, and you can come to whatever conclusion you want is sort of how it comes out, right? And it really depends on whether the big players in the lithium space put in the money to build these new projects, which exist. So that's one of those, my takeaway from lithium is it's happening. The supply is there. It may not be ground isn't being broken right now, but it's not in a dearth of supply in a way that excites me to jump into the lithium space. But other people have a different conclusion.
But so basically there are all sorts of lithium reserves out there. They know where they are, and it takes several years to develop them. But when the suppliers think the time is right, they can flick the switch and be in production a few years later. Yeah,
essentially. And lithium is dominated by very large companies who have the, pocketbook depth to do that. It's not like they're capital constrained. They're decision constrained, like you say.
Yeah. They're more like an OPEC, although I don't know if they have a cartel there, but they can decide, hey, we don't want to ramp up too much production because then that'll push down prices, but we can't let it get too high because then these other guys will come in and start producing. So they need to OPEC it, where having sort of balance that supply demand where they have healthy profits, but not too many new entrants come into the market. Is that fair?
That's an absolutely fair characterization. And so that kind of team control of the space probably means there won't be crazy price runs, right? Because they don't want, like you say, to encourage a bunch of people to come into the space. That actually works against them, but it also protects the downside. So like it'll trundle along and, projects will work if they work, but probably not an exciting space. Whereas there are some other battery components. And I mean, it seems boring when I focus on copper and nickel for electrification because everybody wants you to talk about something more sexy. But I'm like, copper and nickel are the sexy ones for me. Like they are the drivers. They're the ones that, they shouldn't be called lithium batteries. They should be called nickel batteries. Like, doesn't matter what battery you use, you need copper to move the electricity. So they're the ones that I like to focus on because they're the most transparent, they're the largest, and the supply issues are very real for both of them.
Well, and just on that, whether they're nickel or lithium or whatever, wherever they figure out to produce the energy or store the energy, whether you need copper to run it. Like there's no, like people are talking about replacements. Well, we can replace this or that, but no one talks about replacing copper.
No, exactly. We tried aluminum wiring and, a lot of things caught on fire. So
yeah,
absolutely. Yeah. And copper projects are among the slowest often to get into production because they're usually behemoth projects, right? They're really, really big assets that take a long time to delineate and then mine plan and then permit and then build. So there is a major lag between, supply gaps and industry response, supply response. So that plays to the investor's advantage in the copper space if you keep up with where we are in that lag process.
All right.
Okay, so that's like I say, broad strokes on sort of supply demand. It's generally a bullish situation. I don't speak about supply demand for gold and silver. It's not. I don't find that to be useful. So I didn't get on it there. Technicals, I often will throw in charts here about what the charts are telling us. I didn't do that this time. The charts are so crazy right now, especially for gold, that it's more confusing than anything. The summary, and I wanted to keep this presentation quite concise as well, but the summary is that in the short term, we do have some negativity on the technical side. So the charts don't look great. And that means that, the algorithms probably aren't, algorithmic buying probably isn't supporting things right now. And technical traders are being cautious or exiting. But the medium and long-term trends for most of those charts are solidly bullish. So we haven't, there may be more downside in the near term for gold and for silver, but the support levels ahead are not that much lower. And when they hit those levels, the broad consensus, even from the technical analysts, is that there's more upside ahead. Now, when I talk about the Sunday night attack, this only applies to people, or this is only relevant for people who really pay attention to gold. But there was this crazy thing that happened to gold just a few days ago, where on Sunday night, when US markets were closed, someone dumped 24,000 gold contracts in the Asian markets, which has a nominal value of $4 billion. So this is like a very large dump. And that's what we call an orchestrated bear attack. And so that's people who have short positions on gold trying to push the gold price down. And it worked. It shot the gold price down from almost $100 an ounce, from sort of $17.60 to as low as $16.60. Do I have that? No, I have those numbers right. It regained a lot of that bounce, but these attacks happen for a bunch of reasons. They spark cascade selling, which reinforces the profits for those who are positioned for such a down spike. And they did it when they did it because the technicals were not looking good for gold. Gold had lost ground on Friday because of a strong jobs report. And so that left gold sitting right on one of its support levels. And if it just tipped over, they knew there would be a bunch of sell orders just below that support. I could go on about that for a while, as you might guess, but the takeaway just for those who are interested in the chart side of thing is that, yes, there is absolutely weakness on most metal charts. I'm trying to cover a lot of ground with a few words here, but certainly on the precious metals charts, there's weakness in the short term. And for quite a few of the base metals, there's some weakness in the short term, but if you step back so that you're looking even a few months ahead instead of a few days, then the charts, even technical analysts will say that the charts are still looking very bullish in alignment with those fundamentals. A quick look at history. So I started by pointing out that the commodities index, again, I know that that's oil. There's a lot of oil in there, but it's still relevant, I think, to look at what's happened previously when commodities have gone on such a crazy run to start the year. So Canaccord did a good job of that. They looked at years when commodities were strong for those first 4 months of the year. They excluded really weird years like 2008. And the pattern is that, you have your run, you take a summer breather, and then you go again, right? Add another 9% in the later part of the year. Will that happen again? Well, patterns aren't promises, but they're there for a reason. And that fits with other patterns that are pertinent in this space, in particular, the seasonality of gold, which is pretty darn reliable. Gold really likes to gain ground in September and October. So that also suggests that aligns with the technicals outlook, that things are probably set up nicely for the fall.
I was talking with a sort of a sales guy in the gold sector with gold equities, and he was saying just so many of the gold focused PMs are on vacation right now, and they've just they want to go on vacation and not worry about gold and volatility, and they've sold kind of what they aren't super confident in or the riskier stuff, and then they're going to get back to it after Labor Day. So that a lot of people are just sort of out of the gold sector for the summer. They figure they're not going to miss much, and they just want to sleep and rest in peace.
And it's even if you go back and analyze all the different years, I mean, you can go back a long time, and almost always gold loses ground in July and August. And why does it do that? Because people go on vacation and they do exactly what you said, which is that they exit any positions that they're not super confident in. So that, of course, reinforces the pattern. And then they just bugger off for a while because we all need vacation. And then when they come back in September, they want to re-enter the positions, and they know that seasonality is in support of re-entering those positions. And of course, then they create their own momentum, right? It reinforces its own pattern. So yeah, that's totally a factor right now. But of course, for those who are looking at opportunities in August, that creates a moment, right? That means that if you are bullish on gold or silver, platinum, palladium, copper, whatever it is, at this time in the year, then, August is probably a good time to buy ahead of all of those people returning and starting to push the price up. Now, what's the sort of fundamentals for gold, right? I talk about the fundamentals for the base metals at the beginning as supply demand, but I don't care about supply demand for gold. I don't think that that's applicable. What I think is applicable for gold are real interest rates. And here I don't want to dive too deep, because when I started my talk saying there's so many forces and so little understood, that's what I'm really getting at, right? The forces that push not just real rates around, but also then the perceptions of what those real rates will do are very varied right now. And it's a bit of a quagmire out there. Nonetheless, here's like a long-term, but starting in 2016 chart of real rates. And we can see, right? I sort of charted out what happened in the gold space. The gold bull market started when real rates fell down to the zero level back in 2016. Then rebounding real rates hindered the gold market for several years. And then remember, way back before COVID dominates our memories these days, but there was a time before COVID in 2019, real rates were starting to decline again. And gold was starting to perform even before COVID hit. And then COVID hit, and bam, real rates were slammed into negative territory. And gold went on a crazy run to peak above $2,000 a year ago. Real rates.
Just to make sure real rates are the interest rates minus the inflation rates, right?
Exactly. Yeah, exactly. So the one that we're looking at here is the 10-year inflation index treasury. So this is sort of like a 10-year real rate. Of course, you can look at just interest rates and current inflation all the way through to, you can look at a 30-year and 30-year inflation averages and everything in between. Anytime you're taking an interest rate and taking away inflation, that's a real rate. And you just have to decide which time frame you're looking at and which calculation of inflation you want to use. But that's what real rates are. And the reason that real rates are so important is because when real interest rates are negative, you are disincentivized to own treasuries, right? Because you're paying the government to loan the money. The inflation is going to erode any interest that they're giving you. So there's no point holding sort of dollar-based or euro-based paper. And so gold becomes an alternative. And it's not just that gold is an alternative to not losing money. Gold also performs in those environments. So instead of having inflation take away your interest on your safe haven investment, you choose the alternate safe haven investment that usually performs in those macroeconomic environments. And so we are in a negative real rate environment, very much so. And you can see how closely correlated gold and negative real rates are. That's the second chart here. We have gold, we have real interest rates inverted there to show how closely they move together. So then, of course, the question becomes, well, what's going to happen to real interest rates? Because if they're so important for the price of gold, where are they going? Well, it's pretty confusing right now. I mean, they're going to stay negative. We could spend the next hour talking about inflation and whether it's transient versus persistent and what level it will stay at. My thoughts are that inflation will not remain as aggressive as it is right now, but that a fair bit of it will stick. That said, the data, the macroeconomic data remains mixed. It's been mixed all through this broad equities bull market. So, you know, the house of cards could topple at any point. But I think we're going to have some inflation, and that will keep interest rates in the negative environment. What's ironic right now is that inflation is actually seen as being negative for gold because that encourages the central bank to raise interest rates. And that makes real rates less negative because the first number that you're starting with is higher. But the irony there's just like multiple levels of irony in all of this. The irony there is that gold bull markets often start with rate hikes because they're raising rates because of inflation. If it sounds like I'm going in circles, it's because every bit of this argument is very circular right now because there isn't enough data to know exactly which way we're going. The easy, clear conclusion is that we are in a negative real rate environment. We are going to stay in a negative real rate environment for quite some time. I don't know how negative, and I don't know when the rate hike cycle might start. But what's important to remember is that rate hikes are not necessarily bad for gold. In fact, the last few gold bull markets have coincided with rate hike cycles. So gold is confused, but I really do think that all of the forces that feed into real interest rates actually support gold. You can get yourself very confused and circular in the moment, but if you take a step back and look at the bigger forces, I really think that real interest rates are going to remain negative and supportive of gold as we go forward. If you have that kind of perspective today, so I mean, I'm biased, I'm bullish, choose your word, but oops, sorry about that loud alert. That was my medical device. If you are bullish on metals, whether it's, the electrification argument and, so you're interested in copper and nickel and whatever you might like over there, or if you're interested in the gold side of things because of the negative real rates opportunity, what do you do about it? And I think here, I'm not going to try and even suggest stocks because what you do about it depends completely on your level of engagement with your metals and mining portfolio and your risk tolerance. They're very closely aligned. If you like engaging with your metals and mining portfolio, then you can play the high risk juniors, the explorers, the ones where news flow on a daily basis matters and can move a stock dramatically one direction or the other. There's a lot of opportunity there. There's also a lot of risk. If you like the bullish argument, but you don't want to engage with your portfolio on a daily basis, then you need to take a lower risk approach. And what's great is that both of those I really think will work. Gold miners, copper, I wrote gold miners here, but gold miners, copper miners, silver miners, they're all making ridiculous amounts of money. And they have like no debt and they're paying awesome dividends, like stand out across equities. And so they've been punished in the last little while because of gold sliding overall in the last year. But the basic financial metrics of the mining space are incredibly strong relative to almost every other stock out there. So if or when, that perception shifts for gold or copper or whatever back into bullish territory, interest will flow back into the miners. And I think so that's a very low risk position that one can take to benefit from this overall stance. Now, if you do like to engage with your portfolio, August is also a great time of year to consider adding things to your portfolio because we're in the middle of exploration season. And so results are coming in from all of the companies that are, that just got started on their summer exploration programs last month. And those results will come in over the next 4, 5, 6 months, depending on how slow assay labs are this year. And so if you like to be engaged in the riskier side of things and have that potential for outstanding returns, then there's a lot of opportunity in the exploration space. And then there's a lot of new deals still coming out. So if you like to be early in the game, if you like to get involved in early stage financings, even on the private side of things, there's a lot of new deals still coming to the fore. And so that, again, is another kind of opportunity. My last slide here is about that first thing that I said, miners standing out across equities for balance sheets, free cash, and dividend yields. It's like actually insane how strong they are relative to equities as a whole. And it's the kind of strength that really matters, because what fuels a gold bull market in particular is generalists rotating into the space. And one thing that really encourages generalists to rotate into the space is basic financial strength. And gold miners offer that next level right now. Their dividends are rising. They're set to free cash flow for a lot of them. And look at that free cash flow chart. It's going through the moon. Right now, senior golds are trading at a considerable discount to gold. And in the last bull market, the premiums are very significant. So miners offer fundamental investment sense just on those financial metrics. And they have upside based on the metal price. And that makes sense across metals. So how to play the opportunity, if you see opportunity in the metal space, really depends on how much time you want to spend engaging with your portfolio and how much risk you want to take on. Like I say, those are very closely aligned questions. But once you've answered that, then there's lots of opportunity from low risk to high risk in the spectrum. And now or over the next few weeks is a good time to consider those, because there is a mixed picture in the near, very, very short term here, but then after that, the picture gets bullish. And I am certainly adding to positions in various things for that reason. This long list is the newsletters that my service provides. The Maven letter is my flagship letter. It's about those higher risk opportunities, mostly explorers and developers. I write about what I'm buying and selling, so what I'm doing with my money to try and take advantage of that opportunity on a weekly level. Premium is for those who like financings. I secure allocations for my premium subscribers and financings that I like. And then I have a partner writer named Peter Kraut, who has one newsletter that's all about silver and one newsletter that is about low risk investments. It's called Gold Resource, but actually it's about more than just gold. It's designed for the lower risk investors who want to have some exposure to this commodity space without taking on a lot of risk or the need to follow news closely. And that's what I have to say about that.
And yeah, I just wanted to, like, you talk about the lower risk being the miners, and just always remember, like, if you really not to think about it too much, there are the ETFs on the gold side where they buy the basket in Canada. There's the ZGD, and for the juniors, which are the junior producers, which are still companies that are producing, that's the ZJG. They're BMO funds. And then in the US, there's the GDX and the JDXJ for the US juniors. And then if you just want to buy the gold itself, is the GLD. But if gold is going to go up, you're going to get more leverage. Like if the price of gold goes up by 20%, the miners are going to go up by more than 20%, right? Presumably.
Yeah, that's that classic math, right? Where you presume that a miner's cost of producing an ounce of gold does not change quickly or significantly. So if a miner's average cost of producing an ounce of gold is $1,000 and gold goes from 1,600 to 1,800, then that extra $200 is increasing their profit from $600 to $800, right? So that's the percentage change on the profit line is way bigger than just the few percent that the gold price change. So that's where leverage comes from. So it comes both from that profitability side of things, that a few percent change, you know, they talk about threefold is one of the rules of thumb, like that whatever the percent change in the price of gold is, that miners should get 3 times that in their share price change. So there's that. And then when a gold market really gets established, then there's the momentum argument, which increases that leverage number. It turns that threefold maybe into a higher number. But that's, you know, when a gold bull market really has legs, and we're not quite there yet.
If one is looking at mucking around with the explorers, could you give just sort of some general tips on sort of, you know, usually the best way to not get into trouble is, as opposed to doing positive things, is avoiding the negative things. Like, what are the, like, I would think for me is when, especially, well, with any sort of junior company, but it seems even more so in the Explorer Co's, is look at the management team. Do these guys have a track record of not just, ooh, they've got a nice stock chart on one of their prior deals? Have they actually found something and then been able to develop it, or being able to sell it off for a reasonable amount of money? Or has it just been the same guys just tapping the market every couple of years so that they can, as they say, a lifestyle company? They've got an Explorer Co to fund their bar tab and that. I think I'm on the right tab with that. Any other sort of things to focus on or things to avoid?
You're absolutely on the right track. I mean, I can list a bunch of things to focus on or avoid, depending which side of the street you're looking at that from. I mean, share structure is really important. What the project is, what the approach is. Do they have an actual plan to create value? Do they have access to the capital markets? Like, do they have money? What are they going to do with the money? Do they have a plan B if that doesn't work? But those are all reasonably complicated for someone who is new to the space, everything that I just listed there. So it does really, all of that gets distilled down into who's doing it. So management, and it's not just, do they have a win? A win is great for sure. Some wins are more luck and some wins are more skill and some wins are a combination. What I like to question with management is, like, I like to sort of look at those past deals. I mean, if there's been more than one win, wow, that, because there's a lot of not wins in the exploration space, right? Let's remind ourselves that the odds of success in the exploration and development space are really quite small. So if a management team has multiple wins, that is something to pay attention to. And also, are they doing more of what they're good at, right? If a management team has a win with a lithium play that happened in the last hot lithium market, but now they're searching for a copper porphyry in a different part of the world, I'm not going to discount them off the bat for that, but I'm going to ask a lot more questions because that's not the wheelhouse. The wheelhouse was what they did. And so are they sticking with their wheelhouse? And therefore, you know, they have the experience and the expertise to really take advantage of the market. And so who's doing it? What's their track record? And then I mentioned, do they have a clear plan to create value for shareholders? It seems like that should be obvious, right? It seems like that should be the starting point. But too often exploration companies are treated a little bit too much like science projects and not enough like taking care of investor capital. And so, you know, I want to know why you're raising money right now, what you're going to do with that money, what plans you have in place to try and support your share price while that work is going on. And then what are you going to do if that work produces this result or this result, right? Like, give me a plan. Otherwise, I'm just dumping money in a hole.
Yeah. And then it's something else with management teams and sort of the guys who've got a track record of winning. A lot of guys were maybe like, how were they actually attached to a prior win? A lot of guys say, oh yeah, I was involved there, but maybe he was driving the truck.
Right.
really had not, he just happened to be at the right place at the right time. Were they actually the CEO or the VP of exploration or were they just a sort of a hanger on? So actually see where their resume was
For sure.
don't just take their word for it.
Yeah, for sure. And you want to be able to take people's word for it, but you do need to dig deeper. And those who have that track record of success, you know what? They've gone through, raising money in a bad way versus raising money in a good way. So guess what? They have the experience to know how they want to raise money, and they have the experience to know how to tell their story, and they have access to the market so they can, they have dedicated shareholders who will follow them and provide money. I'm focusing on money because you can't do anything if you don't have money. And then they have, experience telling their story, and they have experience maybe operating in that jurisdiction or similar. They can attract good people to their team because you need good geologists and communicators and permitting staff and all of those positions. You need to be able to attract good people, and good people are scarcer and scarcer in our space because that bear market didn't exactly encourage new grads to flock towards the mining space. We don't have a huge amount of a huge depth of employees out there. So yes, I mean, who it is, what their track record of success is, that is really the starting point for sure. And if you don't feel qualified in assessing that, that's fair enough. That's a reasonable thing to decide, because again, it's kind of complicated to assess these things. But the other thing that I always say is that just don't try and do this alone. Don't try and enter into the exploration space and make decisions on your own, because it's a pretty challenging place. There's a lot of layers that you need to consider in assessing an individual stock, deciding the timing for a copper bull market, whatever it might be. So find a team that supports you. That might be a broker who knows the space and can help you with connections and who you can chat with. It might be, a chat room where you find that there's a good group of people who are having useful conversations about this stuff. It might be a newsletter writer who, writes to a level that makes sense to you and to a risk level that is appropriate. It might be it might be your neighbor. Maybe your neighbor likes to do this stuff as well, but try and find a few people that you can do this with, because it's a lot to do on your own.
It is. And just from my personal experience, I probably know more, of the general population. Very few people know much about mining, but I know more than 99% of the people. But I've learned enough to know that I've worked with some of the top mining analysts with their cubicle next to mine over the last 20 years. And I know enough to know I don't really know anything about the mining. And when I think I know something, I'm like, oh, I didn't know that. I can probably weed out 80 or 90% of the crappy ones. They kind of stick out obvious. But to know a medium one or a really good liar versus a real credible guy, I always talk to people who know, because they'll set me straight.
Absolutely.
And so it's a risky endeavor, and get some good people on your side. And I think you would be a good person on my side, Gwen.
Well, thank you. I try.
So we should probably wrap it up here. Not seeing any questions out there. So are there any sort of wrap up comments you want to make here, Gwen, before we close it up?
Yeah. I don't want everyone, I'm certainly bullish on the space. I'm not blindly bullish. Like I say, I think the near term has some risk. So don't necessarily run out and buy a bunch of gold stocks today and then be mad at me if they don't perform tomorrow, because I think there is some risk in the near term. But I think gold makes sense on most of the paths that the economy, the stock market, real interest rates, and all of that could take. Gold works on a lot of those. We're in a bit of a weird space in the macroeconomic world here, where the tail wags the dog in terms of interest rates and inflation, and how people perceive all of these things as impacting all of the support that the Fed's giving the economy. It's a pretty weird world out there. But that weirdness is why gold works very well on most of the potential outcome paths. And I really do think that the electrification argument and the weak supply against strong demand argument for the base metals, that is inarguable for quite a few of the key metals out there. So I do think that metals and mining is a space that's going to do well over the next few years, with its, bumps along the way. So if you share that perspective, it's absolutely worth figuring out how to get a little bit of exposure in your portfolio. If you have any questions for me, I'm certainly happy to answer them, and I'm easy to find. My website is right there.
All right. And yeah, actually at the beginning, one of the reasons I actually did have you on the call today is because I am kind of bullish. I'm not a perma bull on gold. Every commodity or sector's got its space, but I don't believe in runaway inflation, but the world's going to be more expensive going forward with COVID costs incorporated, with environmental costs, with people onshoring, like moving production out of China back into North America. There's all sorts of stuff going on. So I think inflation's here to stay. And then compared to last year, we're going to see a slowing rate of growth out there. Not that we go into recession, but growth is going to be a little bit slower. So, and for me, that's a good environment for gold. And so I want to sort of get a bit ahead of it. And as you were saying, Gwen, September is a good time for gold. So don't rush out into the gold space, but now is probably a good time to maybe pick away at things and and for heaven's sake, diversify. Don't throw everything at gold or whatever. Weight it up a little bit, but don't get goofy on it. So that's my thoughts.
Absolutely.
All right, Gwen, thanks a lot. That was really, that was fun.
Fantastic. Thanks to you.